We are diving deep into the world of accelerated computing. It's a space where one company has built this fortress, not just with silicon, but with software, and it holds near total control. And just to set the stage for how dominant we're talking, let me drop this stat on you. In the third quarter of 2025, even with AMD and Intel gaining some ground, Nvidia still had a breathtaking 92% of the discrete GPU market.
92%.
It's basically a monopoly. So the core mission for us today is to answer this, well, this $4 trillion question. Is this dominance a sustainable reality, or is it just a historical anomaly that's, destined to collapse?
That 92% is staggering, but you hit on the most important point. We have to look beyond the consumer graphics card in your gaming PC.
Right.
To really understand the power here and the risk, we need to analyze this massive strategic pivot they've made, the very real threats on the horizon, and the historical data that shows these kinds of valuations. But they're almost always fleeting.
Okay, let's unpack that. And I think the best place to start is right at the beginning of 2026 at the Consumer Electronics Show, CES. Because what they did there, it really showed everyone where their focus is now.
It's a completely different company. I mean, the shift is profound, and the raw numbers prove it. For years, the story was all about gamers. Now, not even close. In fiscal year 2025, their data center segment was responsible for, 88.27% of total revenue? That's over $115 billion.
And that's a 142% year-over-year increase, which is just insane.
It is. And gaming. It's been pushed down to just 8.7% of the total, about $11 billion.
So that brings us back to CES 2026. They broke a 5-year tradition. They announced nothing. No new consumer GPUs whatsoever. The entire keynote was AI.
Absolutely. And the centerpiece of that was the Vera Rubin platform, named after the astronomer.
And this isn't just one chip, right?
No, not at all. It's an integrated AI supercomputer. It has 6 different pieces of silicon: the Vera CPU, the Rubin GPU, the NVLink 6 switch. It's complexity on a massive scale.
And the performance claims for that Rubin GPU are, they're designed to just blow everyone else away. 3 times the AI training compute and 5 times the inference compute of Blackwell, their current top chip.
Correct. But here's the technical detail that really, really matters, and we need to clarify this for you. Those performance claims, they're specifically measured for something called NVFP4.
Okay, wait, hold on. For our listeners who aren't necessarily in the weeds on chip architecture, what exactly is NVFP4 and why is that the key metric here?
So NVFP4 stands for 4-bit floating point. In AI, that basically means extremely small units of data.
Okay.
And inference, that's when an AI model actually answers your question or generates an image. It's super efficient when you run it on tiny data units like this. So by moving to 4-bit, they can just pack exponentially more processing onto the same chip.
So it's not just about raw speed.
No, it's about cost. Their ambition is to use their new transformer engine to drop the cost of running AI by a factor of 10. This creates a massive performance gap that justifies the huge premium they charge.
Right. They're making it so you have to buy their chips to stay competitive. And yet, the market had a strange reaction to this, didn't it?
It was fascinating. The stock actually slipped a little after the keynote.
Why?
Because analysts pointed out the timing. The release is for the second half of 2026. That creates what they called a revenue air pocket, where investors are just relying on existing Blackwell sales for over a year. It just fed the rumors of minor delays.
Let's talk about the real fortress around this company, because the secret isn't just the silicon, it's the software. We have to talk about CUD.
The ultimate moat. That's what it is.
Yeah.
CED, the Compute Unified Device Architecture, is the industry standard. And it's not just a driver. It's a whole mature ecosystem.
So it's a lock-in?
It's the definition of lock-in.
Yeah.
Think about it. Developers have spent a decade learning CUD. There are millions of lines of code, thousands of enterprise models all built on it. If a competitor releases a chip that's just as fast,
you'd have to rewrite
everything and re-optimize it. That massive switching cost is the barrier that protects the entire company.
So that's the tech advantage. But they're also expanding in ways that seem almost contradictory, like their big push into open source for autonomous driving.
Exactly. This is their strategy to spread CDA everywhere. They released the Alpamayo platform. It's got a 10 billion parameter model, open source simulation tools on GitHub, Huge driving data sets. They were literally giving away the foundational AI.
And we're seeing it in the real world already. Mercedes-Benz is rolling out their Drive AV software in the new CLA in 2026.
And if you connect the dots, this is brilliant. Here's the irony. Tesla is one of their biggest customers. They use tens of thousands of their GPUs to train their models.
Right.
So Nvidia profits whether Tesla wins or Mercedes wins. They're selling the shovels to every miner in the gold rush.
It's high-stakes gambling, though, trading immediate control for that long-term platform lock-in. Okay, we focused a lot on the data center, that 88% revenue driver. But let's quickly pivot to the only consumer bone they threw at CES. DLSS 4.5. Why even bother with gaming at this point?
You have to. It's about brand loyalty. It's still an $11 billion business, and it's the funnel that gets future developers hooked on your ecosystem. DLSS 4.5 is their tool for keeping that loyalty.
And what technical problem was it actually designed to fix?
It fixed a visual flaw that's been around for a while. In older versions, the AI sometimes struggled with compressed brightness values.
Meaning things looked off.
Yeah, dark areas looked crushed, and bright spots, like neon signs, looked kind of muted and dull. The new model was trained on the original raw brightness values from the game engine. So now your vibrant reflections actually look bright again.
It's like using AI to fix a problem that earlier AI created. They also introduced this thing called dynamic multi-frame generation. They called it an automatic transmission for the GPU.
It's a great analogy. The system automatically adjusts the frame multiplier to match your monitor's refresh rate. If a scene is really intense, it cranks up frame generation. If it's lighter, it backs off. The goal is smooth performance without you having to mess with the settings.
So that's the tech story. Dominance, big future claims, a software moat. But now we have to turn to the gathering storm. The risks here aren't just from AMD and Intel.
That's right. I mean, while AMD with its MI300X and Intel with its Gaudi chips are definitely fighting for contracts, the real long-term structural threat, it's coming from their own customers.
Explain that structural conflict of interest.
Okay, get this. The company's 4 largest customers account for nearly 60% of their total revenue.
60%. Who are they?
The big hyperscale cloud providers, Microsoft, Google, Amazon, the giants who spend billions on GPUs. And here's the kicker. They are all aggressively developing their own custom silicon.
Google's TPUs, Amazon's Trainium, and Inferentia.
Exactly. They are funding their own competition just to reduce their dependency on a single supplier. That's a huge headwind.
And the risk goes deeper than that, right? Down to the physical manufacturing.
Yes. This is what I'd call the supply chain time bomb. They operate on a fabless model. They design the chips, but they rely entirely on third-party foundries to make them.
And that's all concentrated in one place.
Overwhelmingly. TSMC, which is primarily located in the, let's say, geopolitically sensitive Asia-Pacific region.
So we're talking about a single point of failure, a typhoon, a geopolitical event. It could disrupt the entire global supply of advanced AI chips.
That is the literal risk factor that I think a lot of investors are choosing to overlook.
And that brings us to the core financial risk, valuation compression. The growth is phenomenal, but the price-to-earnings ratio was, what, 53 in mid-2025? That's sky high.
It's extremely high. And analysts are already warning that when the supply of AI chips finally meets demand, which is projected for mid-2026, the company will lose its pricing power.
The ability to charge whatever they want because they're the only game in town.
Exactly. And when that erodes, margins will drop sharply from these historic highs, even if revenue keeps growing.
This is where we need to bring in some historical perspective. Because investing at a peak valuation like that, it means you're betting that this moment is permanent. And history just refutes that every single time.
Every time. Think about the giants that seemed untouchable. Digital Equipment Corporation, DEC, they were the king of mini computers. And then the PC came along and their whole business model just vanished.
Or Quantum and Maxter with hard drives.
Disintegrated almost overnight because of SSDs in the cloud. And of course, BlackBerry. A decade ago, they were the dominant smartphone innovator. Then the iPhone and Android ecosystems made them irrelevant.
The cycle is ruthless. And we have actual data that shows this price decay happens even to the most revolutionary chips once competition scales up.
Look at Intel's own history. The Intel 386 chip launched in 1985 for $1,000. Within 5 years, its price dropped over 95%.
Wow.
Or the Titanium 2 in 2002. Launched at $4,000. 5 years later, its price was down over 98%. The pattern is undeniable. pricing power on advanced chips is always temporary.
Let's walk through what this means for the stock price using two possible scenarios, because this really highlights the role of market perception, that PE ratio.
Okay, let's take scenario A, the optimistic case. Let's assume they keep up a very strong 50% annual revenue growth for 3 years, and investors still give them a high PE ratio of 30.
So still a premium valuation?
Right.
Right.
Under that scenario, you get a phenomenal 85% stock gain. Great outcome.
But what's the other side of that coin?
Now look at scenario B. We assume slightly lower, but still very, very strong, 40% annual revenue growth. But here's the key. Investors decide to apply a PE ratio of 20, which is more typical for a large-cap tech company.
More historical average.
Exactly. Under that scenario, despite incredible growth, the stock actually suffers a nearly 20% decline over 3 years, a 19.7% drop.
And that is the critical takeaway for you. The risk isn't just about growth slowing down. It's about investors today paying a premium, that PE of 53 that future investors facing a more competitive market might just not be willing to pay. The valuation compression alone can wipe out years of incredible growth.
So if you synthesize this whole picture, their dominance comes from that full-stack approach, amazing hardware tied to the sticky CUDA software. But that very same dominance makes them structurally brittle. They have huge customer concentration and a dangerous supply chain dependency.
So the historical cycle is just waiting.
It shows us every dominant hardware platform eventually fades. The ultimate question for the next 5 years isn't just whether AMD or Intel can finally crack that CUDA moat. It's whether the entire AI computing paradigm itself evolves beyond GPUs entirely.
To something else like neuromorphic or photonic computing.
Or even quantum. Does that shift happen before the competitive pressure and the inevitable valuation compression really take hold? That's the real question.
That is a powerful final thought. The forces of nature, both economic and technological, are always at work. Thank you for joining us on this deep dive into the $4 trillion question. If you want to keep getting the crucial insights and surprising facts you need to stay well informed, make sure to follow and subscribe to the channel so you never miss another deep dive. We'll be here next time, ready to unpack the material you share with us.